Welcome to Proven and Probable. I'm Maurice Jackson, and I'm delighted to have you here today. Before we begin today's video, make sure you give us a thumbs up and leave a comment in the comment section below. And as always, we thank you for your continued support. And just a reminder, we sell physical precious metals through Miles Franklin Precious Metals Investments. We offer physical delivery to your home, precious metal IRAs, and Brinks depository accounts. You can reach me at 855-505-1900. That's 855-505-1900. Or you may email Maurice at milesfranklin.com. That's Maurice at milesfranklin.com.
Welcome back to Proven and Probable, where we bring you the most insightful conversations in the natural resource and precious metal space. Today, we have the distinct honor of hosting a true titan of our industry, a mentor to many, and a man whose market acumen is legendary. I'm proud to present to you Mr. Rick Rule. Mr. Rule, welcome to the show.
Pleasure to be back with you, Maurice. By the way, I'm delighted with the success that you've demonstrated in your channel over the last 10 years. You've done a spectacular job.
Thank you for the kind words, sir, and much of that credit goes to you and your mentorship as well. Before we begin, allow me to congratulate you on yet another fantastic symposium. By that, I'm referring to the preeminent resource stock symposium in the world, the Rule Symposium. And thank you for allowing me to be an MC, I believe going on 8 years in a row at the symposium.
Well, I'm delighted that you have been part of our symposium, promoting it ahead of time, reporting live from the conference, being part of the general scene. This year was the best attended on record. We've been putting it on for about 30 years. We had over 600 people live, and we had another 1,400 live stream. Since the conference, we've sold over 100 recordings of the conference. So in terms of attendance, we did a great job. In terms of attendee satisfaction, we did well too, Maurice. As you know, we offer an unconditional money-back guarantee for anybody who doesn't believe they got their money's worth. Out of more than 2,000 attendees, we had 2 refund requests. So less than 0.1% weren't happy with the proceedings. So I think we did a really good job at the conference. I'm delighted by our speakers. I'm delighted by our exhibitors. I'm delighted by our attendees. I think you were there. I think a good and valuable time was had by all.
I would certainly agree. And I was, if you will, from the street side of it, I was just an attendee as well. And it was just a resounding, I love this symposium, especially from those that were first-time attendees. They couldn't believe just the wealth of intellectual capital that was there and the professionalism of everyone, and including the opportunity to meet you. May I ask you, is it too late for someone to still participate in the symposium?
Absolutely not. The recordings will be on sale for another 2 months, and they will allow people to review the entire 55 hours of the proceedings, including all of the breakout sessions. And they come with a full money-back guarantee. I would ask that somebody, of course, play all the tapes. But if you play the tapes, if you play the recordings and you don't think you got your money's worth, I don't want to charge you. So by all means, and as I think you can attest, Maurice, there was some very, very, very valuable information, timeless information at that conference.
Absolutely. Now, speaking of other symposiums, Friday, the 22nd of August, you will be in Vancouver speaking at my favorite philosophical forum, Capitalism and Morality, hosted by our friend Jayant Bhandari. Can you share with us what you will be discussing?
Capitalism and Morality is a very different kind of conference. It's not primarily an investment conference. It's more of a conference around philosophy, around individual liberty, around free market thinking. One of the premises is really the morality of free markets, expressed perhaps best by Thomas Sowell, who said, how much of someone else's wealth do you think belongs to you? The premise behind capitalism and morality is that we are all free people, and we are entitled to the fruits of our own labor without depredation from others. My speech this year, for the first time, will be more financially oriented than philosophically oriented. I'm going to talk about something I talked about at my own conference called, namely, the math of America. talking about the macro math around the budget, around deficits, around our ability in the future to sustain the Commonwealth at the same time that we sustain the capital investment needed to maintain the lifestyle that America has enjoyed for 200 years. It'll be fun.
I know it will if it's coming from you. And
I
finally,
also need to say,
oh, yes, sir.
this year I've teamed up with a student organization called Students for Liberty, a young libertarian organization. And my wife and I are sponsoring 30 young students from the Pacific Northwest, Washington State, and British Columbia. So there'll be a 30-strong contingent of students at the conference, which I think will add a lot of sizzle to the proceedings.
Oh, it sounds exciting, and I know that they are delighted. And finally, November 2nd through the 5th, Mr. Rule will be speaking at the New Orleans Investment Conference. Ladies and gentlemen, if you're interested in the aforementioned events and wish to meet Rick Rule in person or watch him online, you may register for these events in the description box below this video. Now, Mr. Rule, your ability to foresee trends and identify value, often against the prevailing sentiment, has been invaluable to our audience over the years. We're particularly excited today to have you dive into your current outlook and hear about your latest groundbreaking endeavor. Sir, let's begin with the big picture. From your unique vantage point, how would you characterize the current state of the natural resource market globally, and what are the dominant forces or challenges shaping the sector right now?
Probably three things that investors need to consider around natural resources. The first is that I think we're experiencing right now in real time an economic slowdown. The weakness in oil and gas prices, as an example, against a declining US dollar, would suggest that demand on a global basis is soft. There's a lot of discussion that says that we may be entering a recession. The data suggests that we've already entered the recession. And the intermediate and longer term outlook is a little cloudier than it's been too. Historical fact, and we've talked about this before, Maurice, the period 1982 to 2022 was a 40-year epoch that was as benign for investors as any in history. I think that epoch ended in 2022. And I think that we have a reckoning that we will survive, but a reckoning that will test us. Here's why. In 1982, aggregate government debt relative to gross domestic product was about 90%. In other words, we owed at the federal level about 90% of GDP. This year, aggregate government debt exceeded 120% of GDP. And more challenging, the off-balance sheet liabilities of the U.S. government, which is to say the net present value of entitlements, Medicaid, Medicare, Social Security, military pensions, federal pensions. That number, according to the Congressional Budget Office, exceeds $100 trillion, or 3.5 times GDP. It isn't just the aggregate size of the on and off balance sheet liabilities, but rather the size of those liabilities relative to the size of the economy, whose surplus would go to pay those debts and pay for those services. Those are real challenges, Maurice. And I think that the way society deals with that challenge will be, rather than default, to allow the purchasing power of the dollar to decline, meaning that we would honor the nominal value of those obligations, but we deflate away the net present value of that obligation. It's worthy to note, historically, that we did this in the decade of the 70s. In the decade of the 70s, the purchasing power of the US dollar fell by 75%. And I think that's precisely what happens over the next 10 years, that the purchasing power of the US dollar falls by 75%. I'm not talking about the relative value. I'm not talking about the US dollar relative to the Canadian dollar, relative to the euro, relative to the renminbi. I'm talking about the purchasing power of US dollar savings will fall, I believe, by 75% over 10 years. If you are comfortable is the wrong phrase. If you believe that math, then you need to look back to the 1970s for the solution. During the 1970s, when the purchasing power of the dollar declined by 75%, the gold price went up 30-fold. I'm not suggesting that the gold price will go up 30-fold. It's already up 12-fold since the year 2000. But I suspect that the nominal price of gold will increase to mirror the decline in purchasing power of the US dollar. If the math were exact, that would suggest that if the purchasing power of the dollar fell by 75%, that the gold price could increase 3 or 4 times. That, the specter of inflation, means in the context of the natural resource market that although the gold market has done well and the gold stocks have started to do well, that we are fairly early on in what could be a very, very, very significant bull market. We could talk about it later in the interview. But my suspicion is that the math of America suggests that gold-oriented investments, both by way of bullion and by way of gold equities, will be a wonderful place to be over the next 10 years.
It sounds if I may.
Go ahead.
No, sir, you go ahead.
Going over to natural resources, the outlook is different. Natural resources are economically sensitive. And to the extent that we enter a recession, particularly a synchronized global recession, we reduce demand for natural resources, which left on its own reduces the price of natural resources. Looking further out in the decade, or sooner, if we don't have a recession, what you're going to deal with is the fact that society around the world has underinvested in natural resource productive capacity for 30 years. In the oil business, as an example, right now, the International Energy Agency suggests that the oil industry, including government-run oil firms, are underinvesting in sustaining capital investments to the tune of $2 billion a day. Now, the impact of that underinvestment isn't felt in 6 months or 12 months. It's felt in 24 months or 36 months or 48 months. But this systematic underinvestment in sustaining capital will reduce our ability to produce oil 2 years from now, 3 years from now, 4 years from now. And that's repeated throughout the commodity sector. We have underinvested in productive capacity for uranium, for copper, for a whole variety of natural resource topics. As the world population grows and as the poorer parts of humanity become less poor, demand for resources grows. But in order to meet that demand, you need to have been investing in the decade of the 90s, in the decade 2000 to 2010. We're 30 years late in terms of building productive capacity, and you will see that impacted in commodity prices over the next 10 years. It will be choppier than gold, but this systematic underinvestment suggests that commodity prices in both nominal terms and real terms will be substantially higher 10 years from now than they are today.
Rick, your comments on the proposition in oil reminds me of a conversation you had at the Oxford Club Investment U conference in 2016, where you asked the audience, do you believe that the lights will go on in 5 years? And if they answered, they raised their hand. You basically shared, I should say, that you believe that the price of uranium will go up. And at that time, the price of uranium was around $18 and then shot up to 106. So your call there was correct. And I believe that your call here will be correct as well.
Provided that people give me time, what I've learned, Maurice, in commodities is that if you have a commodity that is necessary for the continuation of our lifestyle as we live it, and that commodity is priced below the cost of production, which is to say the industry is in liquidation, there are only two potential outcomes. The commodity becomes unavailable and our global lifestyle changes dramatically and for the worse, or the price goes up. With uranium at $18 at that point in time, the total cost break-even for uranium producers on a global basis was probably $40. So you make the stuff for 40, you sell it for 18. Being dumb miners, you try and make it up on volume. It doesn't work. Either the price goes up, or the fuel that generated 20% of U.S. baseload capacity at that point in time becomes unavailable, which is to say either the price goes up or the lights go out. Those are the two choices. That kind of stuff is easy. It's difficult for people to make themselves buy an industry in liquidation. It's difficult to buy companies that are losing money in real time, even if you sort of believe that they will do well over time. Most good narrative requires, for most people, a demonstration in the market, which is to say the uranium price has to move before people believe in the narrative about why the uranium price will move. The ability to anticipate those is what separates the good contrarian investor from the herd-following victim.
Yes, I was about to share. A wise man once shared, either you're a contrarian or you're a victim.
Slogans are good. They save you a lot of explanation.
They certainly do. Are you observing any significant shifts in investor behavior or capital flows into the natural resource sector, and what's driving those changes?
Well, we're in a go bull market now. In 2023, numerous people expressed frustration about the fact that the gold price was moving, but the gold stocks weren't moving. That was easy to explain. The gold price was moving because central banks were buying it. And central banks don't buy gold stocks. But what you see in a precious metals bull market is repeatable. First, the gold moves. Often, as the gold moves, the cost of producing gold goes up too, and that happened in 2023. Although the gold price escalated, the costs of producing gold escalated, and producer margins didn't increase. So, in addition to the fact that the central banks weren't buying gold stocks, the gold companies themselves weren't enjoying the margin expansion that people thought they might as a consequence of higher gold prices. That began to change in 2024. The better gold companies got a handle on costs, and companies like Wheaton Precious, who was, of course, an exhibitor at our conference, and Agnico Eagle soared 100% gains. This is predictable. Oh, when the margins expand, the biggest and the best producers move first, and they move dramatically. As that happens, valuation discrepancies begin to emerge, which is to say, somebody like Agnico Eagle trades at a higher percentage of net asset value than a smaller, less robust company. And that valuation discrepancy is either addressed by value arbitrageurs, myself as an example, beginning to buy the smaller companies, or the big companies take over the little companies. But suffice it to say, market momentum moves all the way down the quality train, from the best of the best to the best of the rest, to the junior producer, to the developer, to the explorer, finally to the penny dreadful. And we are probably now a quarter to a third of the way through that continuum. I believe, for reasons that I stated earlier in this interview, that this gold bull market has a long way to go. But in terms of investor participation, what you've seen, if you measure it crudely by attendance at our conference, is in 2 years, conference attendance has doubled. You are now seeing high quality gold equities not merely move, but really truly being on fire. Lundin Gold, as an example, Alamos Gold, the aforementioned Agnico Eagle, some of the developers, Artemis is up 900%. So yes, the investor is absolutely positively participating in the gold equities market now. Financings that 2 years ago would have struggled are now substantially oversubscribed. So it isn't just that people are participating in the secondary market, they're participating actively in the private placement market. Volumes in gold-oriented index funds are increasing, although the prices aren't necessarily. So yeah, we're in a gold bull market, and the investor participation that we said would be coming 2 years ago is here now.
From a contrarian perspective, where do you see the greatest disconnects between market perception and underlying value in the natural resource space today?
I think you need to look in places where nobody is looking. You need to look at commodities that people don't care about, that haven't moved. And I think you need to go to countries that people are uncomfortable with. When gold stocks move, everybody wants a gold deposit, and they want it in the United States or Canada. If you have a bunch of competition, you can't get bargains. So a couple themes attract me. The rare earth theme attracts me. It attracts me because there's geopolitical competition for rare earths. It attracts me because we haven't looked for rare earths for 30 or 40 years because they were too cheap, but they're not going to be too cheap in the future because Chinese production costs are going up. And so very, very high quality, very large rare earth deposits attract me. The two that attract me particularly are in Brazil, and there are a lot of people who are uncomfortable investing in Brazil. So looking at very large, $20 billion plus in situ reserve and resource deposits that would be in the best cost quartile worldwide and would be in the highest return on capital employed worldwide, but ones where there are some unanswered questions or where they're 3 or 4 or 5 years away from a production decision, where time mitigates against investor perception, where ignorance around rare earths mitigates against investor perception, where Brazil mitigates around investor perception. Circumstances where you have $100 million market cap that could easily be a $2 or $2.5 billion market cap. That attracts the contrarian in me. I'm also, as I say, I'm attracted to markets that other people aren't attracted to. So there's a rutile and graphite deposit in Malawi. Most people can't spell rutile and think graphite is what's in a pencil. and they can't spell Malawi either. Again, this is in terms of in situ reserves and resources, likely to be a $20 billion deposit, but with unanswered questions. The market capitalization again is sub 100 million, maybe a little bigger, but it could easily be a $2.5 billion market capitalization, which would be a 20 bagger if things go right. Had we had this interview a year ago, Maurice, I would have said that platinum and palladium were out of favor. Of course, the platinum and palladium prices are up by 40% now, but the nickel price is still in the toilet. So ultramafic deposits, platinum, palladium, nickel, are out of favor. There are two that I know of in Brazil, one a platinum and palladium, explorer, Bravo Resources, who was at the conference. Another would be Centaurus, a sulfide nickel deposit. Those are the things that I like. Assets that are out of favor in countries that are out of favor, where there are some unanswered questions that I believe but do not know will be answered favorably. That's where the 10 baggers come from, the 20 baggers, the 30 baggers.
Now, for our audience members, many of whom are focused on identifying early stage opportunities, how do you approach the risk management in these often volatile sectors?
Maurice, you start with people. If I don't know the people, or I don't know somebody who knows the people and will vouch for them, I don't touch them. You want people to have been successful in the past, and you want them to have been successful in a task that closely resembles the task at hand. If one's definition of success is that the person operated a producing gold mine in 2 billion-year-old Archean terrain in French-speaking Quebec, but the task at hand is exploring rather than operating for copper-gold porphyries in 15-million-year-old tertiary volcanics in Spanish-speaking Peru, the success isn't necessarily translatable. So the people have to be successful, and they have to be successful at a task that closely resembles the task at hand. And it isn't just the promoter that has to be successful. If the company's going to need to raise money, has the CFO raised money before? If they are going to construct a mine, has the CFO presided over the distributions of funds in a big construction project before? Has the head of exploration demonstrated success in exploring for the deposit type in similar rock terrain than they're exploring for now? That's where you start. The second place that you go, I think, is scale. Big mines or small mines have big risks, but only big mines can make you big money. So the idea that you take big risk for small money is very, very unattractive to me. It's sold all the time. Entrepreneurs buy it. The idea that you can start a small mine and you can use the cash flow from that to grow and grow and grow without having to issue stock. Wonderful rhetoric. Almost never happens. So if I take big risks, I want big money. Importantly, Maurice, companies become more valuable and gradually higher priced as they answer unanswered questions, as the market becomes more aware of the latent value within the deposit. So it's important for you as a speculator in early stage companies to identify, first of all, what the company's worth now, what the liquidation value is. That tells you what your downside is. And then secondly, what the most important unanswered question is. How long it will take them to get a yes answer? What's the probability of a yes answer? What's the yes answer worth? And how much money will be required to answer the question? Let's say, Maurice, that the company in question has a gold anomaly in northern British Columbia, and the gold anomaly has been identified by surface sampling, grab sampling, often selective. Interesting anomaly. It looks like it has potential size, but you don't know if that gold is in situ or if it's transported, as an example. And you don't have the third dimension. You don't have the depth. And you don't even know how well it's distributed because the grab samples were selective. It might be that the unanswered question is, do we have ubiquitous mineralization? And it might be that the way that you answer that question is by 20 or 30 trenches, a systematic trenching program to measure the potential target size. And it might be that, if you went to sell the anomaly, an anomaly identified only by selective surface sampling, that you could sell it on the street to some other junior for $250,000 or something like that. But if you were able to establish a legitimate drill target, over the indicated size of the anomaly with 30 trenches, that it's likely that that target, that drill target, would be worth $10 million. Pretty good step, 250,000 to $10 million. It might cost you $1.5 million to test that, and it might take 2 field seasons. So this is where the sleuthing comes in. You identify the unanswered question. You identify the process by which the question will be answered. You look at the cost, $1.5 million, and you look at the G&A that the company will have to sustain for staying alive for a year and a half. Let's say that's $1 million, and it comes up $2.5 million in 18 months to answer the question. If the company doesn't have the $2.5 million, you have to ascertain where and how they will get it. If they can't get it, you have to get rid of the stock. Mm-hmm. If you're never going to get a yes answer, you can't own the stock. And if you think they can get it, you have to be prepared to own the stock for 18 months until that question is answered. I hope that helps.
It certainly does. It's priceless wisdom. Again, thank you for your insights. Beyond the obvious, what are some less talked about catalysts that could drive significant re-ratings in these areas that you've identified as opportunities?
Well, the things that I identify as opportunities involve really 2 things. A series of answering unanswered questions. The deposits that I talked about earlier in this interview, while large, need better metallurgical understanding. They need denser drilling, and they need, in most cases, the completion of a bankable feasibility study, a third-party valuation. They also are going to require 2 or 3 years of permitting and financing. So there's lots and lots and lots of unanswered questions. That's why you have a $2.5 or $3 billion deposit in a $100 million wrapper. No free lunch, you know. But I like to be asked big questions where the probability, not the certainty, but rather the probability of the answer is yes. I really like that circumstance. And in the case of the companies that I've identified as opportunities, while there's no certainty around the outcome, the probability is a yes. I've also learned that I compete, Maurice, against speculators that have the attention span of a gnat. They often get the narrative right, a 4-year narrative or a 5-year narrative, but their tactics are constrained because they have trauma holding stock over a long weekend. I'm attracted to circumstances where the value creation chain will take 3 to 5 years, a much longer attention span than most of my competitors have. And I've learned that for me, the really truly profound moves that I've enjoyed in my life have taken 5 years or 6 years. And by the way, in most of those, and you've watched a couple of them, during some part of the time that I owned the stock, I experienced a 50% share price decline. Mm-hmm. So in addition to being patient, you have to be persistent and tenacious. Those are, by now at age 72, traits that I have.
How important is market cap to NPV to you?
Very important. I realize that I can't, in every circumstance, buy dollars for dimes. But what the equation market cap to net present value or indicated net present value does is it establishes your downside. It lets you know how much you could lose. If the aforementioned company that has a $250,000 deposit in it, which is to say a deposit that could be sold on the street for $250,000, if that company has a $10 million market cap, you need to understand that if they don't get a yes answer, that their G&A will strangle them and they'll go to zero. You have to be comfortable with 100% loss of capital. If by contrast, that company completes, as an example, the trenching survey, and the trenching survey comes back and validates the deposit, and the company now has a market cap of $12.5 million, but it has a net asset value of $10 million, you could be much more comfortable. Not completely comfortable, because you're still paying a premium to net present value. You're paying a premium to net present value because you believe the next unanswered question will be answered by 5 to 10 drill holes. Does the deposit extend to depth? And you know that a yes answer with regards to this deposit extending to depth could give you a 100 million market cap. The move from 12 million to 100 million is a very handsome move and probably justifies the risk of paying $12.5 million in market cap for $10 million in net present value.
Before we leave resource stocks, we're proud to share that three of our sponsors are and have been exhibitors at the Rural Symposium. Can you briefly share some of the merits of Riverside Resources, EMX Royalty, and F3 Uranium, and why speculators should consider their investment propositions for their portfolios?
Well, I need to disclose that I'm a shareholder of two of the three. So Riverside Resources is a prospect generator. It's run by a brilliant geologist, Sean-Marc Stouty. It's particularly useful to know that he was head of new business development for both BHP and Teck, which means that he knows the mindset of the companies that he will be selling projects to. He has kept the company in place for 16 years with very little dilution, and in fact, he has spun off three or four related companies and returned by way of dividend equity in those companies to his shareholders. He's in fact distributed more value than he's raised and kept the share count very, very, very small. I am both a personal friend of Jean-Marc and I'm a shareholder in Riverside. Tiny market cap, no need for dilution because they spend other people's money, and always exploring for long ball home runs. If he connects, notice I said if, you're going to make a very indecent amount of money. EMX Royalty is much more mature. I'm delighted to say I'm a founding shareholder of EMX Royalty. I think I was shareholder number 2 going back many years ago. I believe that EMX Royalty is selling at half its net present value, most of the net present value being in producing or soon to be producing royalties, in particular the Timok royalty in Serbia, where the operator Zijin Mining is running 12 rigs on a hitherto undescribed discovery. We don't know what they found, but we know from Landsat photography that they have 12 rigs running, which suggests it's fairly profound. As I say, I'm a large shareholder there. I was a founding shareholder. F3 Uranium, you're really backing a team that's made 2 prior economic uranium discoveries. This is their 3rd effort. I'm no longer a shareholder of F3 Uranium. I am a personal friend of Dev Randhawa, and I have been a beneficiary of this team's exploration activities in the Athabasca Basin for about 3 decades.
All right. Shifting our focus now to physical precious metals. Rick, your insights on gold and silver are foundational for many. Today, I'd like to shift our focus to platinum and palladium. What are your current thoughts on these 2 fascinating metals?
Well, I remember the last time we talked, they were deeply unloved. And I said that I believe they were due for a dead cat bounce. They've got that. They're up 45% off their lows. I think they can continue to go higher. I think the reason for their declines were pretty easy to understand. The first is that, like the price declines that these metals suffered in 1990, these coincide with Russia's need for cash. When the Russians have need for cash, they sell whatever is in inventory. And being the world's lowest cost producer of platinum and palladium, they had that in inventory. The really decided weakness in platinum and palladium markets began coincidentally with the Russian invasion of the Ukraine and Russia's need for cash. The second thing is the perception in the market that we've seen the end of the internal combustion engine. Platinum and palladium's predominant industrial use is catalytic converters, reducing the smog emissions from internal combustion engines. The big thinkers of the world, Joe Biden, Angela Merkel, Al Gore, Greta Thunberg, the true geniuses, will tell us that the internal combustion engine is going the way of the dodo, except it isn't. And you don't see a lot of public clamor asking for more smog. What that means is that demand for platinum and palladium is going to be strong for a lot longer than the naysayers believe it is, never mind the efficacy of platinum and palladium in reducing emissions from things like petrochemical plants or oil refineries. The third is that platinum and palladium are produced really, in economic terms, only 2 places: South Africa, which is a basket case, and Russia, which is only marginally better and is at war. If you saw more internal discord in either South Africa or Russia, and that involved production shortfalls, demand for platinum and palladium is very inelastic, and you see a spectacular supply response. Remember, Maurice, that it takes less than $150 worth of platinum and palladium in a catalytic converter to enable the sale of a $50,000 or $60,000 or $70,000 car. If the platinum price doubled, it wouldn't change the finished price of the car. So demand for platinum and palladium relative to their price is extremely inelastic, or put differently, the price is extremely elastic. For those reasons, I continue to own platinum and palladium.
How do you weigh the industrial demand, especially from the automotive sector, against the investment demand for these metals? And how do you see the balance evolving with new technologies?
Platinum and palladium, unlike gold or silver, has price increases that start with the shortfall of supply relative to industrial demand. When that happens, speculative interest picks up. The speculators seldom anticipate shortage. The platinum and palladium narrative has to be demonstrated by price action before the speculators come into what is originally an industrial market. If my belief as to precious metals prices is correct, which is to say this market will be led by gold, but at some point in time, the narrative will be justified by gold's momentum and the generalist investor will come into the space. When that happens, market leadership goes to silver. And platinum and palladium can expect to enjoy some speculative favor. If that speculative favor coincides with shortage in industrial capacity, like 1993, then I think what you see is a real rally where fabricators must buy the stuff at any price and speculators anticipating that front run the fabricators. I've seen that happen 3 times before in my career. It's a lot of fun to participate in.
Not asking for a price prediction, but what is the probability that the gold to platinum ratio reverts back to where platinum is higher priced than gold?
I honestly have no idea. As I say, I'm expecting over the next 10 years that the gold price itself does very well. And the ratio between gold and platinum isn't one that I have enough faith in my own ability to analyze to answer the question.
Now, for those considering adding platinum or palladium to their holdings, what are the practical considerations regarding acquisition, storage, and liquidity?
Well, first of all, buy from a trusted dealer. We're coming into the point in time where precious metals are doing well enough that they're enjoying a lot of investor favor, and new dealers are coming up everywhere. You got to deal with somebody who has a good industry reputation. You've had the good sense to affiliate yourself with Miles Franklin and Andy Schechtman, just such a dealer. I prefer buying physical metals for storage at Brinks or Loomis. I prefer to store my metal in vaults that are controlled by publicly trading companies so that I can see the balance sheet and the income statement of my vault on a quarterly basis. I don't want to have made the right decision with regards to precious metals and have my vault go broke or have some unscrupulous operator steal my platinum and palladium. So I only store my physical metals in Brinks or Loomis. Now, a lot of investors, for various reasons, practice self-storage. I call that midnight gardening. They take physical delivery and they bury it in the backyard. I'm not a fan of that. That exposes you to a whole different set of risks. People coming to visit you who you normally wouldn't have over for lunch. Personal preference, but in the panoply of risks, a thief with a gun is a greater risk to me than depreciation of the US dollar. So I prefer physical storage in vaults controlled by publicly traded companies.
Well, thank you for the plug in there for myself. As a reminder, we are licensed to sell physical precious metals through Miles Franklin Precious Metals. We offer physical delivery, precious metal IRAs, and Brinks depository accounts. I stand by the following comments. I've provided the highest returns on physical precious metals for my clients, and I'll give you an example if I may. Mr. Rule, in 2017 at the Sprott Symposium at the time, I was interviewed and I was asked what I was buying, and the answer was silver, platinum, and rhodium. And the interviewer did not know what rhodium was. At that time, rhodium was $890. It skyrocketed 4 years later, actually 3.5 years later, to $29,000. And yet my industry peers only talk about gold and silver, where we focus more on platinum and palladium, but we love all of the precious metals. I will be honored to have an opportunity to earn your business. Please give me a call at 855-505-1900. That's 855-505-1900. Rick, you embarked on a truly ambitious and potentially transformative venture with Battlebank. For our audience, could you please introduce Battlebank, what it is, and what fundamental problems in the traditional banking industry it aims to solve?
Well, I would ask your listeners to ask themselves how happy they are with their current banking relationships. Having asked that question, I suspect that virtually all of your listeners would respond that they are unhappy with their current relationship. I've been a bank investor and a bank customer now for many, many, many years. And let's just say it, I'm a rich guy. I should be a great customer. And my relationship with my existing banks is somewhere between sullen and mutinous, and it should be great. The Battlebank story goes back really to 1999, where on my living room floor, then in Carlsbad, California, something called Everbank was born. Everbank was our last effort, and we took it from a standing start in the year 2000 when we opened to, in 2014, net asset value of $28 billion and 275,000 customers. We did it by offering branchless banking. Your phone, your computer was our branch. For people who weren't technologically sophisticated enough to do that, we decided that they should go to regular banks. We decided that regular banks should service dumb people, and Everbank should service smart people. We did a few other things, but that was, at the time, very unusual. Not having branches reduced our operating costs enough that we could pay more for our deposits. We could pass on the savings to our depositors. And unlike other banks at the time, we didn't have 15 or 16 different kind of accounts, some of which paid you no interest. There was a high yield money market account that you could write checks against, and we paid interest on your checking. So we like to say at the beginning, if you're interested in interest, think about Battlebank, because we will pay interest on your interest. The other thing that we did at Everbank, which we're going to do at Battlebank, is we allowed people to save in, at that point in time, 28 currencies. When we opened Battlebank, 20 currencies. Don't want all your money in US dollars? Do business in Canada, as an example. Canadian dollars, Australian dollars, New Zealand dollars, Swiss francs, euros, pounds, yen, renminbi. There are points in time when other currencies outperform the US dollar. Or if you're a business person that does business in two countries, you need to bank in two currencies. At Battlebank, you will be offered FDIC-insured certificates of deposit in 20 currencies in addition to the US dollar. Another key difference, Maurice, is that at Battlebank, your IRA or your solo 401k is actually yours. At most other institutions, the IRA has a list of permitted products, which is mostly annuities, mutual funds, stuff like that. At Battlebank, your IRA will allow you to purchase physical gold or silver. It will allow you to buy a duplex or a triplex. It'll allow you to buy a franchise. It will allow you, in the right set of circumstances, to buy crypto, if that's what you choose, in your IRA account. In other words, your IRA is your IRA. It's not a receptacle for Wall Street products. Finally, a critical difference between us and all other banks, including Everbank, is that Battlebank, you will be able to access credit secured by your physical holdings of gold, silver, platinum, and palladium. If you were fortunate enough to have been stacking gold and silver, as I have for 25 years, and you have a pile of gold and silver, but for whatever reason you need to access the credit, perhaps there's a good deal on a duplex in your neighborhood. Perhaps you need a down payment on a summer home. Perhaps you want to access credit to buy more gold and silver. We'll provide a credit line secured by your gold and silver so you can have access to the capital that you have tied up in your gold and silver without having to sell it and pay the capital gains tax. This is available from the big banks. As an example, Royal Bank of Canada will do this. The problem is there's a $10 million minimum. At Battlebank, our minimum is $100,000 for gold stored at Brinks or Loomis or Viamat. I'm delighted to say that we have agreements, credit agreements, with 4 of the largest and finest bullion dealers in the United States, including Miles Franklin.
That is paramount, ladies and gentlemen, and that's one of the many virtues that really has me excited about Battlebank. May I ask, will Battlebank be publicly traded?
Hopefully not. That'll be up to the shareholders. Our last bank, Everbank, grew so quickly that we had to go to Wall Street for capital. And the capital that we raised, some of it at least, came from these financial services hedge funds. And they became much more interested in their exit strategies and our quarterly performance than they were in building a bank for its customers. My hope is that Battlebank will be owned by its depositors, its borrowers, and its employees. And at some point in time, we'll have a trade sale. It took us 14 years to fashion an exit for Everbank. The early investors, over 14 years, made a 30 to 1 return in a $2.8 billion sale to Teachers Investment and Annuity. My hope is that Battlebank will be privately owned until it is sold in its entirety to a bank buyer.
Navigating the banking regulatory landscape is notoriously challenging. What have been the biggest hurdles or unexpected opportunities bringing Battlebank to the market?
It took us 19 months to get our last bank approved. With this bank, I believe we're 54 months and counting. So what we've chosen to do is buy a small bank in upstate Minnesota, in Uppsala, and then rather than get approved by the FDIC for a bank charter, merely get approval to recapitalize an existing small bank. We bought a very, very clean bank in a very small town, and the vendor of the bank actually bought all of the loans from us. So what we're buying is a clean bank with about $45 million in deposits. Very clean regulatory record, and this short circuits the de novo requirements that have become so onerous in American banking.
How do you see Battlebank evolving or potentially disrupting the broader financial services industry?
Well, it's interesting that we have a very clean bank going into what I think will be very difficult economic times. Silicon Valley Bank went broke because the median duration of their loans was 8 years, and those loans are funded with overnight deposits. When the interest rate went up, the capitalized value of their loans went down, and their cost of funding went up too. The depositors could see the squeeze, and because most of their deposits were wholesale deposits, the deposits left and the bank went broke. Battlebank has no legacy long-term loans. And we aren't going to have fixed rate long-term loans. When we originate mortgages, as an example, we will mature them, which means we'll collect the first 3 interest payments, and then we'll sell the mortgages on, allowing those mortgages to be on the books of insurance companies or other banks. We won't have long-term obligations at Battlebank. We'll have 1-year obligations secured by physical gold or silver, or prime rate obligations from investment grade companies around the world that are 1-year duration and are floating rate. So we won't make the type of legacy mistakes. The second thing is that to the extent right now that you had, and I'm not saying that you will, but if we had a precipitous decline in commercial real estate mortgages, there's well over $1 trillion in commercial real estate mortgages on the balance sheets of the big banks. They'll need some time to work that out. While they're working it out, they won't be able to compete with us for making good loans. Starting a bank that's a disciplined bank in a period where the economic challenges facing the incumbents make them less vital competitors is precisely the thing that we enjoyed in the year 2000. You may remember that the first part of the decade of the 2000s was a very tumultuous time.
Yes.
Other currencies did well against the US dollar. There was dislocation, particularly later in that decade, 2008. That was a very difficult time for incumbent banks that hadn't been structured as conservatively as Everbank was. And Battlebank is being structured in the same very conservative, very liquid fashion. So to the extent that there's economic turmoil in the next 5 years, ironically, it should be particularly advantageous to Battlebank. Battlebank will not try to be all things to all people. The great big banks, the JP Morgan Chases, the Bank of Americas, they might lend to 500 industries. It's impossible to know 500 industries. We'll lend to industries that we know very well, and we'll lend to people who are often depositors, people who we know well. We will have lower cost of operations because we won't have branches, and we'll have very low customer acquisition costs. When we opened Everbank, our existing customer backlog was 0. There are about 18,000 people now on the Battlebank waiting list. And these people, many of them have told us specifically what products that we'll be offering that are of interest to them. So I think we'll open this bank with a bang. We'll have a low customer acquisition cost, a low operating cost. We will pass some of those savings on to our depositors and our borrowers, and we'll pass the rest on to our shareholders.
When will Battlebank go online, if you will, for depositors?
Boy, that's a $100 million question. I'm going to guess 120 days from today, but that's a guess. The best way to find out is to go to battlebank.com and get on the waiting list. We will keep you apprised of our progress and notify you when we're ready to do business. We would ask you to notify what of our products and service are of particular interest to you.
That 120-day window is actually an opportunity that I want you to share with us, because this allows an opportunity for accredited investors to participate. Is that correct?
That is true. We want our bank to be owned by our depositors and our borrowers. We don't want it to be owned by Wall Street. And accredited investors have an ability to contribute capital right now.
Is there?
There's a convertible preferred offering out that pays 7.5% interest. It converts at the price of the last equity issuance that takes place once we're allowed to open. As I say, we would like our bank to be owned by our depositors and by our borrowers, not by Wall Street. And people who are listening to your show are precisely the type of people, self-actualized people, people who believe in gold and silver, contrarian investors who we would like as shareholders. Maurice, I actually must excuse myself. I have another call to be on right now, but thank you very much for this opportunity, and I look forward to be invited back.
Always a pleasure to have you in the program, sir. Thank you.
The information presented on Proven and Probable is provided for educational and informational purposes only, without any express or implied warranty of any kind, including warranties of accuracy, completeness, or fitness for any particular purpose. The information is not intended to be and does not constitute financial, investment, or trading advice, or any other advice. You should not make any financial, investment, or trading decision based on any of the information presented without first undertaking independent due diligence and consultation with a professional broker or competent financial advisor.